If you're a medical or dental professional earning over 1.5 million in your practice, there's a chance you might be overpaying on your taxes. I know this because I've worked with many high-income professionals just like you who were leaving money on the table every single year. And it wasn't because they didn't have accountants or financial people in their corner, it was because they were making the same critical mistakes other entrepreneurs could be making. They treated their businesses like an enterprise, but then neglected their personal wealth. In this video, I'm going to walk you through some of the strategies we use to help medical and dental professionals with north of 1.5 million practices potentially reduce their tax liability by 100,000 or more. I'll cover some of the information you'll need so you can finally stop overpaying the IRS. And this isn't just basic advice. These are some of the same advanced strategies that ultra high net worth individuals used, applied specifically for medical and dental practice owners. My name is Omar Murillo. I am founder of Imperial Wealth Advisors, and I am a certified financial planner practitioner. So if you're tired of writing those quarterly tax checks and you're ready to keep more of what you earn, stay with me. Strategy number 1, strategic use of modern retirement plans. Many high earners underutilize retirement plans because they stick to only the basics of maybe a 401k, and therefore they miss significant tax saving opportunities. Consider instead incorporating a cash balance plan alongside your 401k, because for a $1.5 million practice, this could add an additional $150,000 to $300,000 in annual pre-tax retirement savings. Now, of course, this is going to depend on age and circumstances, but let's run some hypothetical numbers. For a 45-year-old practice owner with a W-2 of $500,000, the standard 401k contribution limit for 2025 is $23,500. And in compliance with IRS limits, they can also have a profit sharing component, which provides an additional funding opportunity of $46,500. If we stack on top of that a cash balance plan contribution of $185,000, you're looking at a total $255,000 in pre-tax contributions. At a 37% federal tax rate, that's a potential tax deferral of $94,350, and it could be more if you live in a state with income taxes. Anywhere else, it could be north of $100,000 unless you live in Florida. Customization opportunity is available because the plan can be designed to primarily benefit you as the business owner while still meeting ERISA requirements. Strategy number 2, entity structuring and income shifting. The common mistakes are operating as a sole proprietor instead of taking advantage of S corporation structure without having strategic entity planning. A more sophisticated approach would be to establish a management company created separate from the practice entity, and this management company can then be the one that owns the share of the underlying entities that each provide different services to the practice, such as admin, marketing, management. The benefits of this structure is that you're able to shift income to more favorable tax treatment, you get additional retirement plan opportunities, you get to legitimately employ family members, and take advantage of different expense structures. Strategy number 3 would be real estate optimization, and this is for practice owners who own real estate. A common approach is to have a simple LLC owning and collecting rents, but this leaves opportunities on the table. Another hypothetical to consider is the impact of a cost segregation study. Why? Because this helps accelerate depreciation deductions, creates substantial tax savings in the early years. For a 1.2 million medical or dental office building, you're looking at anywhere between 20 to 30% of components being eligible for depreciation, and they can be depreciated over 5, 7, or 15 years instead of over 39 years. That creates an additional $100,000 plus in deductions in the first year. There are bonus depreciation provisions that can be combined with the cost segregation, and in essence, what bonus depreciation does is expand the first year depreciation allowance for the cost of business property, such as an office building, and in this case, the impact could result in dramatic reduction of your tax liability. Strategy number 4. This is the $10 million plus tax loophole, but this is not applicable to medical or dental practices. It is the qualified small business stock, or better known as QSBS, up to $10 million in tax-free capital gains, and it applies when your business is being sold. It's not just for tech startups. Manufacturers of products that are used by medical or dental practices, for instance, can qualify with proper structuring per the June 20 25th ruling of IRS 202125004. Essentially, in a June 25th letter ruling, the IRS concluded that a manufacturer of products prescribed by third-party healthcare providers was engaged in qualified trade or business, and therefore they were eligible for QSBS. Some key requirements to keep in mind to be eligible for the qualified small business stock: you need a C Corp structure, and the gross assets of the business must be under $50 million. At least 80% of the company's assets must have been actively used in a qualified trade or business. The stock must be held for at least 5 years. Planning horizon is for a qualified trade or business owner planning to exit in the next 5 to 10 years, and this approach could save millions in taxes. But key part here, it requires advanced planning, very well in advance. Strategy number 5, advanced charitable planning. Common approach versus the strategic approach. The common approach is writing checks directly to charities. This misses tax optimization opportunities. Better approach is a donor advised fund. Large contribution in a high income year provides an immediate tax deduction, and then it gets distributed to charities over time. Alternatively, a more advanced strategy is utilizing a charitable remainder trust. In a hypothetical study, let's go over an example of a practice owner with appreciated assets. The benefit of creating a charitable remainder trust in this scenario is that it provides income for life and it generates an immediate tax deduction. So for example, a physician with a $3.2 million practice valuation is able to reduce their federal tax liability by $1.1 million at today's highest tax bracket of 37% and still maintain lifetime income. Bear in mind that the assets will no longer belong to you, but the income does stay for the rest of your life. This could also result in a reduction in potential estate taxes at the grantor's death. Strategy number 6, risk management and asset protection. Not directly tax strategy, but it is a crucial component. Some physicians and dentists focus only on practice liability, neglecting personal asset protection. A bank, for instance, would never let you close on a home without having insurance on it if they're providing a mortgage. Neither would an auto dealership let you drive a car off the lot without having proper insurance whenever you're getting a loan for a vehicle. Now, if they are so protected of their money, shouldn't you protect your wealth the same way? Now, that's when comprehensive asset protection comes in. Having specialized trusts for personal assets, utilizing family limited partnerships or LLCs, having proper insurance coverage, specialty-specific disability is very important. Strategic use of retirement accounts, taking advantage of ERISA protections. And beyond that, what are the benefits? Well, this course of action protects your assets. These protections don't shield from capital losses stemming from securities underperformance, but they do provide considerable sheltering against creditors and financial predators, as well as income derived from specialization. It creates additional tax planning opportunities as well. So those are 6 strategies that could help a 7-figure practice owner reduce their current tax liability by 6 figures or more annually. Obviously, implementing what I've shared requires specialized expertise and coordination between your financial advisor, CPA, attorney, and insurance professionals in some cases. But here's the thing. Most practice owners I meet are great at running their business, but they neglect things on the personal side because they don't have time or expertise to coordinate all of these moving parts alone and keep the business going at the same time. So at this point, you really have 2 options. You can close out this video and do nothing, but that usually comes with the nagging feelings and stress and the fear of missing out, and I don't want you to deal with that anymore. Or you can take the first step towards securing your wealth by reaching out to someone with experience helping people like you who can guide you through the process. That's where my team and I come in, and that's exactly who we are at Imperio Wealth Advisors. We specialize in helping high-income entrepreneurs, particularly medical and dental professionals, reduce their tax liability through strategic tax, retirement, and wealth planning. So if you're a practice owner earning north of $1.5 million or more and want to see if we can help you save on your taxes, click on the first link in the description to schedule a strategy call with us. On this call, we'll discuss your specific situation and identify potential opportunities you might be missing out on. So thank you for watching. And for actual wealth planning from a licensed advisor and certified financial planning professional, subscribe, and I'll see you on the next one.